2026 is coming up real fast. The tax brackets are going to change. So what I want to show you in this video is how these tax brackets are going to affect you, how the tax brackets actually work. Most people do not understand how they actually work. They think it's a flat system when it's not. And finally, I just want to give you some ideas of what to do at the end of the year or during the year of 2026 to save some money in taxes. So how do these brackets affect you? First, let's understand how and why they're made and why they change every year. The standard deduction and all the brackets change every year. One of the reasons why these brackets change is so you do not get caught in the middle of a pay increase due to inflation. And now, because of inflation, if these brackets do not change, you will be pushed into a higher tax bracket. That it's not fair. That's the reason why you get these tax brackets going up every year. General inflation. Now that we understand why tax brackets change, now let's understand how they work for you and what is normally misunderstood how they work. For example, some people say, well, I made $200,000. I'm on the 38% tax bracket, so that would give you 38% times $200,000. Well, that's not accurate. I want to explain to you how the system works and how really you're being taxed. So most people would think on $388,000, they would pay about 32% in taxes. So assumed tax on $388,000 at 32% is $124,160. So now let me explain to you how it really works. First, we're going to take 10% of $12,200 of the first $12,400. Now, from $12,401 to $50,400, you are at the 12% tax bracket. The difference is $37,999. This, now we're going to multiply at 12%. Okay, so that will be $4,559. Okay, so now we take from $50,400 and we take the difference to the next level of bracket, which is $102,000. So that is $51,600. And that is going to be now at 22%. So that is going to be $11,352. Now, we're going to take the difference from the 102 to the 195,000. That difference is $93,000. And that is going to be charged at 24%. So that's going to be $22,320. And now we're going to get to our last tier in this particular example. So we're going to take the difference between the 195 and the 388. That is $193,000. And that is going to now get charged at the 32% tax bracket, $61,760. Now, when we take and we add all of this, let's take a look at what the real situation is going on here. We take all these tax brackets. Do you see how it's not a flat tax rate? So this was our assumed tax. Now let's take a look at when we add all of these at what the actual tax was. So the total is actually our actual tax is going to be $101,231. Which is not $124,000 because of the rates, how they go up. Now, the actual rate of tax was, if we take $388,000, we're going to take the actual tax, which is $101,231, divide it into the $388,000. So the actual rate was 26%. Not the assumed 32%. 5%. That's how you're actually paying taxes. This is the actual rate, not what the tables seem to show. It's not a flat rate. Same thing for everyone else. Married, filing jointly, the same thing. You would have to take a look at that and you would come up with the actual rate. This is how tax brackets actually work. Now that we know how the tables work, the standard deduction also changes in 2026. Now, a single person standard deduction is $16,100 and married filing jointly $32,200. Every time you calculate your taxes, you take your gross income and you will deduct these at very minimum, unless you itemize. But at very minimum, you would deduct these and then calculate your tax. So let's assume you made $100,000 and you're married filing joint. You would deduct the standard deduction, which is $32,000 in 2026, and then you would calculate your tax. What can you do now to save some money on taxes in 2026? First, if you're an employee, you want to look at your withholding. Make sure you're withholding the right amount based on the calculations that I've shown you. Now, one of the things that we want to do is contribute to a 401k, an IRA, an HSA. One of my favorite ones is the 401k. Why? Because most plans will allow you to borrow against it and pay yourself interest. So a lot of people will say, I don't want to put the money in a 401k because I'm putting all that money away and I just don't have access to it. Yes, you do have access to it. Just gotta borrow against it, and it's your own money that you're earning back and paying yourself. And you also took advantage of subtracting a bunch of taxes in the year that you put this money towards a 401k. HSA, health savings accounts, perfect way to deduct it from gross income. This is big. You can do whatever you want with it, and most of these accounts will be rolled from year after year. You're not losing anything if you don't use it in the year that it was put in. If you are self-employed, calculate your estimated tax payments. Now your estimated tax payments, let's say, are about $4,000 every quarter. But go now and calculate your estimated tax payments contributing to whether it's a 401k, a SEP IRA, an HSA. When you do these, when you take these into account, calculate how much are you really paying, and then make the decision about your estimated tax payments. And don't forget, charitable giving, they carry a special moment when it comes to taxation. Let's assume that you bought this glass for $10 and now you're going to donate it, but when you do, the fair market value of that donation is $1,500. This applies to art and different things that people have. If the fair market value of that item is $1,500, you're able to take the fair market value of that item as a deduction in your taxes. Any crazy fair market value increase like that must be on a written document from a licensed professional in the art or in the item that you're donating. Now that you understand why tax brackets go up, how and why your tax bracket is the way it is, and some savings for 2026. If you like this video, like and subscribe. If you have any questions, please leave them in the comments below, and I will see you next time.